Hello and welcome to your Property Empire. I'm Chris Gray. On tonight's show, what has been the capital growth for all of our capital cities in the last quarter and year? What can we expect for the growth in 2017? And should you be buying property in your own name or in a trust structure? Well, joining me tonight to comment on our stories is Rob Southwell, Managing Partner of Pitcher Partners Accountants and Advisors, and Charles Tarbey, Chairman and Owner of Century 21 Australasia. Now, we'll start tonight by looking at how well our various capital cities have performed from a capital growth perspective, and we'll pull up a quick graph on the screen. But, Rob, you've got this data from, I think, CoreLogic. Do you want to give us your quick thoughts on it?
Sure.
The
overwhelming theme here is that the year-on-year figures for the last 12 months are probably the highest they've seen in the last 4 or 5 years, obviously with the likes of Sydney and Melbourne having more than sort of 15 to 20% growth in the last 12 months. And I guess you're starting to see those growth figures eke into some of the other capital cities. You know, some interesting ones there around, you know, Hobart and Canberra, strangely enough, as well. But, you know, the phenomenal growth figures, which I think are pretty rare for if you look on the long-term returns over the last 20 years. It's been a pretty phenomenal 12 months.
And this is why normally when I look at it, I don't actually look at kind of the month or more the kind of the quarter or the year, because there's always little fluctuations, isn't there, Charles?
Well, there are, and that's an incredible result when you look at it, given the fact that everybody was suggesting the market had already peaked a year ago, and we couldn't see the change because the interest rates dropped and it just kept going. But the one that hits or stands out the most is the one we've been talking a lot about, is Canberra, and that continues to move along at a very rapid rate. I'm not sure that those figures, well, they seem incredibly high for year on year, they really do. But I wouldn't be surprised if Canberra's right on the money.
And I think these are, actually it was dwelling values, because I was thinking it could just be houses, which would obviously be a bit of a difference. But yeah, 17.5% for Canberra, and it's
massive.
A lot of money.
It's massive, yeah.
There'll be some happy politicians down there.
And it's still moving, and they're still subdividing, and they're still creating suburbs, and they're still running short of stock. So how can you pick it? Because there's a report out this morning with one of the majors, not banks, one of the major investment houses suggesting that we reached the top of the market and it's now on its way down because the clearance rate's dropping below 80% in Sydney. I don't know if anybody can really pick it at this point in time.
Yeah. Now, Rob, there's obviously a lot of commentary that came with these numbers. Is there generally much of a difference between houses and units from what they were saying?
It depends on which state you're looking at. For example, there wasn't that much difference between houses and prices in Sydney, but in Melbourne, house prices were probably 3 times the growth that of units, which and very similar trend in Brisbane, which seems to indicate that there is probably a supply problem, or if you phrase it that way, in those areas that you know, there is an awful lot of new developments coming on, and particularly in Melbourne over the last 8 to 10 years has had a lot of high density construction happen there as well. So,
and still going, and same in Brisbane, same in Sydney. It's still moving along. There are quite a few developments that have been shelved because people were nervous, but you're seeing more apartments coming out of the ground than you are seeing blocks of land and residential development occurring.
And again, people have got to read into these, because if you're just looking at units, a second-hand unit that someone's been living in for 30 years is completely different to these brand new builds with 1,000 in the tower.
For the young couples, when I was selling real estate, if I can vaguely remember when that was, they'd always go for the new homes. They always go for the new properties, but the established were always so much better value. And I don't quite know. I know there are incentives now for people to buy brand new homes, but the reality is that the established market is so much better value in many cases.
Now, Rob, you're obviously a numbers man coming from an accounting firm. I guess the easy thing to do is say, well, the total returns in Sydney were 22.5%. I'll just go and buy a property in Sydney and I'm going to make lots of money. Is that necessarily true?
Yeah, it's that easy, Chris. No, I wish it was. No, I guess you have to remember that these types of numbers are 1 in 10-year events. I would say, in the sense that, you know, your typical longer-term growth trends are 6 to 8%, and your yields on top of that. And then you've got to look within markets. There'd be plenty of markets within Sydney that haven't got anywhere near that, and there'll be other areas that have got in excess of that. So you can't just go and buy any old thing and expect it to deliver you 20% year on year.
So if there's an average 10% growth, and there's some going at 20, some going at 0, and probably some even minus 10 and over 20.
And a lot of those areas don't factor in future supply as well. I mean, if you look at the eastern suburbs, it's no secret that there's not a huge supply of developments available to build high-rise, where you're going out in some of the more suburban areas, or underdeveloped areas, where they're getting permission to build 15, 20-storey towers on them. So you have to be very, very... do your homework about the demographics of the area that you're buying in as well. So.
Now, Charles, APRA's obviously trying to control our growth through restricting the banks, but I think the average across the whole of all the capital cities was something like 12.9%.
Yeah,
which
hasn't worked, has it? It hasn't worked.
But 12.9% doesn't sound like ridiculous amounts, does it?
Look, normally, if you look at the fact that real estate would generally double every 7.2 years, that was the statistic. It's certainly lower than that number. On average. So if we take it as an average, it's certainly much higher than it has been over a period of time. But I guess if we take the cycle and start again in maybe from 2 years ago to the next 5 years, we might balance it back out again, because there was a significant period of time where there was absolutely no growth. Yeah. And you really thought, why the hell am I owning real estate for? Because nothing was happening. So you've got to take it over a long period of time, but that over 1 year as an average across the country is very high.
Yeah. It's up there. Now, obviously, one of the ways to try and control this growth, especially in Sydney and Melbourne, is the banks trying to put up rates, or at least kind of stuff up the or not stuff it up, the serviceability, make it harder on the serviceability things.
Short swap shares, Chris.
Again, could that be an easy excuse for the banks to say, hey, we could make a whole stack more money here and let's blame it on APRA?
Well, the cynical... I mean, to be fair, APRA have been very vocal, but the cynical accountant in me says that, from my very limited understanding of how to run a bank, if you've got a loan book, the easiest way to make profit is sell more loans or have a better spread. And when you've got your regulator telling you can't sell any more loans, the easiest way to do it is to increase your spread. And, you know, there's not much... If people still want to borrow, there's not much you can do about it, particularly when the banks are all heading in the same direction.
It does solve a problem, though, by... looking at the rates changing. I really am not uncomfortable with it. I think it's a good thing, you know, because I've always been concerned...
Is that because you don't have any loans,
I do. Not at that. That's the thing. I learned...
TDs, it's all about the term deposits.
When you get to retirement age, it's a different thing.
Yeah, you've got to focus on the income.
I think I'm already there. When you look at the rates and what they've been like, and how difficult it's been over a period of time for some people, I think it's a good thing, because the Reserve Bank can't do a lot. And I think the banks have to take charge in this instance. I think APRA and the banks have really got to lift their game. And I hate saying this, because real estate goes against everything you think about as a real estate agent. But I think they've got to have a very close look at housing loans and make a very strong decision about who they should be lending money to and how much they should be charging them.
But again, if you're effectively saying the banks are controlling the residential market, that's a pretty scary thing. Like, it's one thing to control their balance sheets, but to control the market...
I'm sure they've got levers to control them, but they've got a chance to move it around right now, and
sure.
I think they should take that opportunity and do that, because I do think the prices... there's only two ways the prices can change, and that's we get that supply happening, or the interest rates go through the roof. And I don't think either are very well controlled right now, and I'd like the banks to be stronger. I prefer the banks to make more money and be stronger than to make less money and be weak where they have been.
Yep, no, fair enough. Before we jump on to Charles's numbers, do you want to give us an idea of their expectations for 2017?
Yeah, so they did a forecast for the next 12 months, and they still predict there to be some pretty positive growth there, looking nowhere near as strong as the last 12 months, but they're still predicting in the region of 10 to 12% in most capital cities. But again, continuing the trend around the units, obviously in some of those cities not being anywhere near as strong or even flat for the next 12 months. And interestingly enough, commenting on Perth, saying that seems to be bottoming out.
Yep.
Again, it's probably a bit like saying that they've hit the top. We've been saying that for the last couple of years. They've been saying the opposite about Perth for a little while, but they're predicting some moderate growth here in the next 12 months in Perth as well. So
wonderful. Sounds good. Well, let's jump into your auction clearance numbers, and we'll see what that can tell us as well.
I don't think they were that bad. I really don't. You know, the average clearance rate across the country is 72.1%. This time last year it was 70, so it's still higher than this time last year. And Sydney came in at 75.8 and Melbourne at 76.8. So Canberra 70.2. I had an interesting situation where the office in Maroubra under the leadership of Nick Pappas and one of their top sales associate, Jamie Van Lee, decided to have something different than an auction because of personal circumstances of the property, and they called it a friendly sale. And they provided all the information you'd normally get at an auction. And this was an old dump of a house, and reserve price 1.7, sold for 1.8 million. And this is in Chifley. Now, we talk about these suburbs you've never hear about, in between other suburbs. So things are starting to happen in those suburbs now, and I think the auction clearance rates are going to continue to be strong. I don't agree with...
But some of the papers are saying this is the turn, and... Yeah. And they're looking at the negative. Yeah. So if there's 5 good properties and 5 bad ones, it looks as if they're turning on the bad ones now to change the reputation of the market.
Correct. And I think it's a bit early to call it.
Don't believe the media all the time.
Well, I'd better not listen to you and I then.
Exactly. Let's have a look at homes advertised for sale.
Well, no, still didn't get there. 2.4 negative, and we had that 12.1% increase going back about 4 or 5 weeks ago. We still haven't. We've had a negative every week since then. It hasn't been negative to the extreme of 12.1% positive, but it's still negative. So.
Right, OK. And moving on to the rent price movements.
They've been down. They went down negative 1.61%, and that wasn't the usual place. Hobart had an increase, or Tasmania had an increase in rent, followed by Sydney at 0.39. So it was a lot of the other capital cities. And if I look at the rent movement again for the year to date, and going beyond the year to date, going back to start of last year, there has been very little increase at all on average. So rents haven't moved very much.
And then finally the vacancy rates.
Very good. Sydney 0.68%, Melbourne 1.36%, exceptional. My pick again, wonderful to hear the news in Perth. It was over 10s. It's been dropping every week. This week 7.78% in vacancy rates. So it's giving an average over those 3 capital cities of 3.27%, something like that. Can you add those 3 together and divide it by 3? Something like that. And
I think on those growth figures, then Perth's negative growth has kind of increased to -1. I think it's about -4 or something before. So do you think there's a bit of a turn?
There is a turn, but there's still areas that people are absolutely being belted, Chris. The negative equity is still an issue. So prices might be coming up in some areas, but people still can't sell.
They've still got a way to go.
Still can't sell. And you've got an exodus of population of those people that used to have jobs there that don't, and so they've gone out looking for jobs. So it's still not there. I don't think it's at the bottom yet. I think it's very close, but I don't think it's at the bottom. It's certainly a place I'd be definitely looking at.
Wonderful. Thanks for the update, Charles, and we'll see you next week. Well, we're going to take a short break. We'll be back soon.
Life taught me to always have a clear vision. Realize timing is key. Be willing to push yourself. Trust technology to support you. But make sure you stay in control. And remember, the biggest competitor is yourself.
Register today at Elite Singles, where you'll benefit from 100% verified profiles, an extensive personality test and tailored matches in your area. elitesingles.com.au. Never more ready to fall in love again.
No matter what we do in life, we owe it to ourselves and our families to make smart choices about our super. That's why we've chosen MTAA Super.
Welcome on board a new way to experience hassle-free boating. As a Pacific Boating member, you'll enjoy the freedom, the relaxation and sheer fun of boating without any of the issues of owning a boat. In fact, with our fleet of luxury cruises, you simply walk on, enjoy, then walk off. So to put the ultimate style into your lifestyle, join the club. Call 1300 Pacific and ask about our trial membership offer or visit pacificboating.com.au.
At Rivers, it's 40% off all full-price clothing and footwear. That's right, 40% off our entire range of full-price clothing and footwear. So layer up this season with a huge 40% off. 4 days only, ends this Tuesday at Rivers.
A rental property can be a rewarding investment, but even with great tenants, there'll always be life's unavoidable accidents and uncertainties. Standard building insurance may not cover damage caused by tenants or loss of rent, leaving you out of pocket. Terry Shear is Australia's leading landlord insurance specialist, with award-winning landlord insurance from $1 a day to protect your property and rental income. Call Terry Shear today or go online.
US President Donald Trump is approaching 100 days in office, and America's role in our region is in focus amid tensions with North Korea. For what it all means for Australia, I speak with former US Ambassador and Labor leader Kim Beazley. Join me, Sky News Business.
Welcome back to Your Property Empire. Well, joining me on the show tonight is Rob Southwell, Managing Partner of Pitcher Partners Accountants and Advisors. Now, Rob, now Charles isn't with us. We've got some technical accounting time.
Very good.
So there's always a big question from a lot of viewers about should you be buying in your own name or these trust structures, which are all a bit of a mystery to the non-accountants. So maybe do you want to explain the difference between the two?
Sure. I think the most common structure, particularly where you have a number of investment properties, probably not the first thing to do for your first property, but is a family trust or a discretionary trust. And they're called discretionary trusts because they hold an asset for a group of people, and every year the trustees get to decide who gets the income from that property, and also if they...
Hence it's discretionary.
Hence it's discretionary, exactly. So what that means is that you have flexibility, but you also have the other aspect, which is around some of the asset protection, which we'll talk about later, which is that no one actually owns the asset directly, so you can protect the asset to a certain level. And there are some estate planning benefits that come with that. I think we're going to talk about this in a minute. But in terms of how you establish one, you go see your accountant or your lawyer. You basically establish a trust deed, which creates the trust. A set law is someone that provides the initial gift, usually $20 or $100 into the trust. And then that creates this notion of a trust, and it defines the family, hence sometimes it's called a family trust. And then you're on your way from there. You get that stamped, you open a bank account, and off you go. So
now, there's always people that reckon they can do it themselves. Is this the kind of thing that you can read a book and say, hey, I'll save some money on accounting fees and I'll just set one up myself?
No, I mean, to set up a trust is not that expensive anyway. You know, it's a bit like setting up a company. You can go and do it all yourself, but, you know, I think normally they're around $500 to $700 to set one up. They're not that expensive. And a deed is very, very important. So having one drafted by a professional is pretty important. So I'd never advise anyone to do it themselves. You know, again, they're a pretty straightforward process from there.
Yeah. Well, let's talk about some of the advantages of using a discretionary trust. And we've got a few graphics that we can put up on the screen at the same time.
Sure. So probably the first one around that is minimising tax, which everyone likes. It's probably one of the still most legitimate ways to reduce your overall level of tax amongst a family group. The way you do that is obviously if you have multiple people within a family, everyone might have different tax situations. Someone might have no income, such as a non-working spouse. You might have adult children over the age of 18. Or you could also then, with some careful planning, you could have other entities, such as another trust or a company, benefit from that trust. So what you're trying to do is year on year minimise the rate of tax that you're paying on the income that's coming out of that trust every year. So
as Kerry Packer said in that famous Facebook video, anyone that doesn't minimise their taxes is pretty stupid.
Exactly, because at the time the government wasn't doing a very good job with it anyway. So, which I thought was one of the classic quotes. So yeah, so that's a big benefit. The second, I think, biggest benefit is asset protection. So someone who is a professional, like a doctor, or someone who's at risk, you don't really want to own assets. Or if you run a business, you're a company director. The idea is that the trustee holds an asset on behalf of a group of beneficiaries, so it's not your asset. So someone comes and sues you, they can say that property or those shares or whatever are yours. No, they're not. They belong to a trust, which is for a group of people, and I don't have a defined interest in it. So they're very, very good at providing that layer of protection.
And again, some people say, oh, look, I'm not in one of those things, so I don't really need it. But again, as if you become wealthy and you knock someone over in a car, or sometimes you just look wealthy and then those kind of claims will come and attract you, then it's still worth potentially doing for the sake of a few $1,000s.
Exactly. You know, a trust is, if it's used in the right way, for the first couple of years probably costs you money, but over the longer term will save you a lot of money, both from minimising taxes and so forth, but also from an asset protection. It's a bit like you've got to do it right from the beginning, because if you're a property investor and you've tried to transfer property in the past, you know that stamp duty is a massive cost, as well as capital gains tax. So you want to set it up the right way from the beginning. So that's really
set it up at the start and it costs you a few thousand, whereas when it's worth a couple of million and you transfer it, could be costing you hundreds of thousands.
Exactly, exactly. So I think people for the, you know, every $1 million it costs you about 50 grand in stamp duty. So yeah, it's a huge cost. So spending that money up front, and most of our clients have experienced that. At the time they sort of say, is this all necessary? But over the longer term, you can really quantify the benefits of having those structures in place from the beginning. So
okay. And the next one, estate planning.
So a trust is created for 80 years. So companies go on in perpetuity, but a trust generally lasts 80 years. So usually you can get 2 or 3 generations passing through and people benefiting from that before the trust has to be wound up. So they're actually quite good from a family perspective in building assets if you're not quite sure of the circumstances that's going to happen with a family. And that's probably the overriding benefit of a family trust is flexibility. You just don't know what's going to happen either from a tax perspective, from a lifestyle perspective. You could start your own business, your family situation could change. So having that central vehicle which owns the assets that you don't have to move all those things around all the time, that's what a family trust provides, a lot of flexibility.
So for instance, in the UK, I think the death tax is like 40 or 50% when your parents pass away, whereas if it was potentially in a trust and it passed to the kids, potentially you're avoiding all that tax.
Yeah, I mean, there is some level of CGT exemption on death, but again, if that passes, you know, you could have, you know, from an estate planning perspective, we've had situations where assets have passed to children. That children, they may not be the most stable in the world, or they could be married to the spouse from hell and they don't want them to benefit from them. So family trusts do give you that flexibility around access to those assets. So.
And then the final thing is you can use it for other investments as well.
Yeah, we have a lot of clients that will hold their passive investments, such as property. They'll have shares, trusts, whatever, investments in, you know, listed property trusts or whatever. But they also hold, if a lot of our business clients will hold the shares in their main trading businesses through that entity as well. So when the dividends come up, they can stream them out and use them as well. So it just becomes your central place to manage all your investments from.
No worries. Now, there's never anything that's always purely positive. There's always downsides as well. So maybe take us quickly through those. Well,
I think, obviously, you mentioned the complexity, but I think if you use a good advisor and you get constant advice, that can be minimised. The second one, there are some additional costs, such as land tax, which I think we've spoken about in the past, whereas you may not get you don't get access to the threshold, land tax threshold, that you might otherwise get as an individual. And I guess thirdly, you know, when you're borrowing from a bank, it can create some extra complexity around them wanting to see your trust deed and understand what assets it might hold. But again, just giving yourself some careful planning and advice can reduce those.
And these days that's not too bad, because if you try to use it 10 years ago, a lot of the banks wouldn't really understand that stuff.
Yeah,
whereas now it's pretty common.
Isn't it? It's pretty common, yeah. So that the banks understand that, but again, it still adds an extra layer of complexity, but again, give yourself enough time to get all that looked at prior.
Yeah, and certainly on the land tax side, no one likes paying land tax. There's a big cheque that you've got to pay out roughly around this time of the year as well. Mm-hmm. And so for a lot of people, if they're buying 1 or 2 properties in their own name, so one in the husband's name, one in the wife's, then maybe that gets through their allowance.
Yeah, exactly, and that's what we usually recommend for a lot of our clients, that they buy that first or second property in their own names and then look at something like a trust for later on for those reasons. So.
Sure, sounds good. So certainly go and see your advisor, not something you can necessarily do yourself. Now, Tom Panas has just landed in the UK, and so I'm going to be taking you through this week's Properties of the Week. Now, with Property 1, we've got a 4-bedroom, 4-bathroom residence, at 62 Napoleon Street in Battery Point in Hobart, Tasmania. It's been featured on Grand Designs in national design publications for its architectural genius. It's a balanced fusion of a circa 1890s cottage with a new ultra-modern counterpart. It's a waterfront location in Hobart's premier suburb and has an extensive outdoor entertaining space. Now, one of the highlights for the green buyers is the use of sustainable materials and the energy efficiencies integrated throughout. There's also a stylish master bedroom positioned off the linkway between the old and the new zones, including a walk-in robe, ensuite and an outdoor bathtub on a private exterior deck. Now, this has got a price guide of offers over $5 million. Now, I guess this goes to show when you see that initial picture of that cottage, if you were just taking a drive-by and you just saw the sign outside, you think, oh, no, I won't bother with that. But, I mean, this is on the positive side. You never know what surprises on a nice thing could be out the back, but there could be some nasty ones as well.
Yeah, I mean, $5 million is a lot for a two-bedroom cottage from first appearances. But, you know, it's amazing what you can find on the internet. I think a lot of people look at, you know, front of places. But if you look at the general surrounding areas, you can get a grasp of what properties actually look like from aerial views as well.
Absolutely a fantastic-looking property there. Now, moving on, we've got property number 2 is a 5-bedroom, 3-bathroom, 4-car home at 52 Cook Street, North Ward in Queensland. It has been meticulously renovated and includes all the modern conveniences and extras you could possibly want or even imagine. There's a stunning white and American oak kitchen with butler's pantry, double sink, 900mm gas oven with teppanyaki plates, stainless steel twin dishwashers and an abundance of storage. So obviously you need to know how to cook if you want to buy this property. The master suite includes a decadent open walk-in robe, dressing room and ensuite with double shower. It's got professionally landscaped gardens with fully automatic irrigation system to both the front and the rear of the property. Outside there's an outdoor kitchen with a 5-burner barbecue, 3-door fully lockable drinks fridge, which is a necessity all the time, and a fiberglass in-ground swimming pool with aesthetic glass pool fencing. Now, this one has got a price guide of offers over $1 million with a rent guide of $800 to $900 a week. And certainly another fantastic property. And for us poor people living in Sydney, where $1 million gets you nothing, it's, I mean, I really like these segments because it really goes to show what you can buy around Australia.
Yeah, absolutely. I mean, I was just up at the Gold Coast this week, and some of the properties up there that are going and being built up there are just phenomenal, and they're, you know, in that sort of $1 to $2 million price range, and it blows your mind. So
absolutely fantastic. Well, thanks for joining us this evening. Until next week, I'm Chris Gray. Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.